Why would a company let go of control over a profitable business, even as another key segment struggles to deliver? That's the strategic riddle at the heart of Universal Robina Corporation's latest move. By selling a 21% stake in its instant noodle joint venture to Nissin Foods Asia, URC will reduce its ownership in Nissin Universal Robina Corporation to just 30%, while Nissin will assume majority control. The official message is orderly. Nissin takes the lead on innovation and branding, while URC focuses on operations. But context matters, and beneath the surface, investors see a deeper set of questions. If this is a refinement, why divest the healthy joint venture when the real pain point lies with coffee? URC's own numbers make the story clear. Operating income for 2025 slipped 4%, with management attributing the decline to sustained high coffee costs. Strip out coffee, and the business would have delivered solid operating income growth. Despite a nearly 5% climb in group sales, operating income barely budged, held back by rising material costs, especially coffee, as gross and operating margins both contracted. Commodity inflation tests every consumer company, but the heart of the issue is pricing power. URC's coffee business couldn't command a premium to offset higher input costs. Management calls this a temporary headwind. Investors may call it a failure to premiumize, a more troubling indictment, given coffee's importance in URC's portfolio. Through the first 9 months of 2025, branded consumer foods drove nearly 69% of sales, yet its segment income stood still, illustrating how top-line growth failed to translate into earnings. Meanwhile, the Nissin noodle venture remains profitable. It generated substantial sales and earnings contributions, even if results tapered slightly year over year. This is not a move to dispose of a weak asset. So why sell down noodles first? For shareholders, the answer is telling. Good capital allocation involves preserving control of cash-generating assets and fixing weak links. Instead, URC is exiting a solid position and asking for confidence in a coffee segment that has yet to prove its margin resilience. Strategic clarity requires more than promises. It demands that capital movements align with areas of true competitive advantage. The sale is, at best, a question mark on management's capital allocation priorities. In moments like this, investors are right to look past the press releases. They're analyzing managerial signals, searching for evidence of pricing power, operating leverage, and a defensible moat. Until URC's coffee business can demonstrate genuine premium pricing, and not just volume or market share, the uncertainty lingers. This transaction is more than a portfolio adjustment. It's a test of strategy, signaling where the company believes its future value truly lies.